about to leave, already packing. Come with me, I'm not really asking. We'll get away to a place where we don't know. About to see the world in action, what we can be, life with no distractions. We'll get away, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out. Die with my own doubts. Be free with me. Let's be free with Not looking back, eyes on the freeway, Bonnie and Clyde, a classic cliche. We're on the run, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out. Die with my own doubts.
Okay, hi everybody, and as that banging music fades away, welcome to our session, our Revision Blast session, which today is going to focus on exchange rates, key topic, and also European Monetary Union. Now, these topics can appear on the macro papers, but also on synoptic questions as well. As always, we encourage those of you watching live to post fantastic comments, contributions, ideas, and thoughts in the chat window, and we will give a shout out to all those, as many as we can, who produce some great answers. Just before we start on exchange rates, quick reminder that we are heading to Bristol, Birmingham, Leeds, London, Manchester and Portsmouth for our economics live workshops. We love doing these. I'm looking forward to doing the London week, for example, AQA and Edexcel, dedicated days each for exam boards, absolutely fantastic days. And those people who come, it's great to meet up, and we have an intensive day of revision. You also get free access to the superb online economics course, which is truly stunning, the Grade Booster course. So take a look at tutor2u.net/workshops for full details. Okay, here we go. Let's make a start on our session on exchange rates and monetary union. Here we go. We'll start with a bubble quiz. I'll give you 5 questions, and you just have to say in the chat room, please, how many answers are correct, which letters are correct. Could be 1, could be 2, 3, 4, could be none of them. Here we go. Which of these countries operate with a free floating currency system? Joe says he loves a bubble quiz. Well, I think we all love a bubble quiz, Joe. Let's see if you get the right answers. Here we go. Which of these countries operate with a free floating currency system? Japan, UK, Denmark, India, which would be quite a tough qualifying group if it was the FIFA World Cup, wouldn't it? Denmark away on a Tuesday night. Toby says A, B, C and D, Abbas says A, B, C, and D. So Toby and Abbas have gone for all of them. How many of these countries operate with a free floating, as opposed to, little hint here, as opposed to a managed floating system? So quite a few of you going for all four. Gabby thinks A, B, and C. Just leave it a few more seconds for the answers to come through. 7, the Greek says A, B, and D. Really important to have good examples, by the way, of countries that have chosen specific exchange rate systems. So here we go. Let's have the answers coming through. The answers this time, it's only B. The UK economy has a free floating system and has had a free floating system since September 1992. Japan has a managed floating system. The Bank of Japan has been actively engaged in trying to get the yen to depreciate as part of their strategy to avoid deflation. Denmark has a fixed exchange rate against the euro, but is outside the euro system. And India has a managed floating system. So be careful there to make a distinction between free floating and managed floating. They are different, and the exam board will ask you questions on that. Not a great start. I was looking for somebody to get the right answer there. It was only the UK. Try number 2. Which of these countries operates with a fixed exchange rate system? And that can either be a fully fixed system or a semi-fixed exchange rate system. So countries on offer here are Hong Kong, Nepal, Bulgaria, and Brazil. Which of these countries have a fixed exchange rate system? Is it 1, 2, 3, 4 of them, or none of them? By the way, I'm not trying to play games here. I'm just asking serious questions. So here we go. Zach thinks it's A, B, and C. Paddy Corbett thinks it's A, B, and C. We're testing your knowledge here of exchange rate systems. Welcome to all those people joining us in the live session here. One of people saying they know that Hong Kong's got a fixed exchange rate, so most people are pretty confident it's going to be A. Tom Manners thinks it's A and B. Abbas thinks it's A and D. So let's have a look at the answers coming through on the screen here. It's A, B, and C. So well done to those who said it was A, B, and C. Hong Kong, yes, fixed exchange rate against the US dollar. Nepal, likewise. Bulgaria, the lev. Again, Bulgaria is inside the European Union, but has a fixed exchange rate against the single currency. Brazil has a managed floating system. Okay, here we go. Next question. If a central, now this is a harder question. Anybody gets this completely right is a serious economist. If a central bank or government wish to see an appreciation of the exchange rate, which of the following measures might it use? Raising interest rates, selling domestic currency and buying foreign currency, currency intervention, allowing financial capital to flow freely out of a country, imposing a tax on inflows of remittances. So I've got a bit to read here. What do we think for question 3? They want to see the currency appreciate. Which of those measures might be consistent with achieving a currency depreciation? So IB678 says A. Remenza, who's joined us in the past on our live streams, she thinks it's A. Tom says, wait, no, just A. So we'll wait for Tom. I think it's A. A couple more seconds. Devanshi thinks it's just A, and Zach, most of you think it's only A. Here's the answer coming through. And you're correct. Well done on that. Raising interest rates cause to attract hot money. Selling currency will be intervention to depreciate the currency. Likewise, allowing capital to flow freely out of a country might encourage capital flight. That will cause currency depreciation. And imposing a tax on remittances, charging taxes on remittances, would of course reduce the inflow of remittances, which would then cause the currency to depreciate, not appreciate. That was a tough question. 2 more. Here's quote, which of these is a likely macroeconomic effect of a currency depreciation? So the currency depreciates, and I think a little bit of a clue here, these are the effects over time, not necessarily instantaneous. So I tried this with some students last week, and they said, well, what about the J curve, and what about the Marshall learning condition? This could be a macro effect over time. Falling cost push inflation, higher demand for imports, a rise in the profitability of exporting, and an increase in aggregate demand. What do we think? Al thinks it's D. Which of these is a macro effect? Devanshi thinks it's C and D. And as the answers come through, we'll take a moment to just give you time on this. Abbas says he just thinks it's just D, an increase in aggregate demand. Misha, 215, thinks it's C and D. And I'll take a couple more answers as they come in as we go through this. TYFC thinks it's D. Choose the ones that you're pretty confident about. If you're a little bit flaky on some of them, don't worry about it. And the correct answer is coming through. The answer is indeed just C and D. A rise in the profitability of exporting. Yes, what happens when the currency depreciates? Often exporters, they don't pass on, they don't cut the price of their exports in foreign markets. They maybe keep the price the same, let's say in dollars or euros. But of course, when they come back to convert into sterling, they take a bigger profit margin. A lot of companies, by the way, do that. They don't necessarily cut the prices of their exports when the currency weakens. They decide to take higher profits. It's often said that UK exporters take higher profits when the currency weakens, and German producers take higher market share. And it should lead to a higher demand, providing the Marshall learning condition is satisfied and the trade balance improves. One more question. We've got loads of people in the live session today, which is fantastic. Welcome to you all. Which of these countries have joined the European Monetary Union? And your 4 countries are Croatia, Poland, Switzerland, and Ireland. Croatia, Poland, Switzerland, Ireland. Which of these 4 countries have the euro as their currency? The Riddler says B and D. Riddler appears on loads of our revision events. Great to see it back again. Luke thinks it's A, B, and D. Likewise, Robin says A, B, and D. And one or two other coming in. Charlie Nash says A, B, and D. Joe Beagle says A, B, D. There seems to be the herd mentality kicking in here. Daniel says it's just A and B. And I have a couple more. By the way, thank you for posting in the chat. It's always fantastic to see the contributions. Zach says A and C. Quite interesting little tweak there. And one more coming through. Juvit says it's A and D. Well, let's have a look. It is indeed A and D. Croatia was the latest country to join the single European currency. We'll have a little session on that in a few minutes. Ireland, of course, has been in since the start. Poland operates inside the EU, but the zloty is a free-floating currency. And Switzerland, as most students know, is outside of the European Union. Swiss franc is an independent currency there. So A and D, the correct answers. Okay, let's move on. I just wanted to quickly take you through some of the key factors affecting currency. So, by the way, yesterday people were saying that they had their revision notes in front of them and they were just adding to the notes as we're going through, which is a great idea. This presentation, of course, is made available and it's available on replay straight after the session, the live session finishes. Now, many factors drive a currency's value. Let me just pick out 5 key ones. A classic exam question might be examine 2 factors that might cause an appreciation or assess the factors that might cause a depreciation of a currency. Trade is important. So typically countries with trade surpluses, where X is greater than M, that's a net inflow of money into the system, and that should normally, other things being the same, cause a currency to appreciate. So countries with very strong current account surpluses, Norway, Germany, for example, Switzerland, Singapore, they typically have strong currencies. Foreign direct investment, also important. So when if a country is favorable to inflows of FDI, including takeovers and mergers, including factories being built, etc., that again drives the currency higher. It's particularly useful, by the way, when you're studying development economics. If you have a very strong inflow of FDI, if it's a small country, for example, and a project worth several $1 billion, that can cause the country's currency to appreciate quite easily. Portfolio investment is really quite significant. Most students don't include this in their answers. So portfolio investment is things like overseas investors buying government bonds, or foreign investors buying property in a country, or investors buying into the equities market of a particular nation. So again, when you have a strong inflow of portfolio investment, the currency tends to go up. Equally, some of you will have studied this in development economics recently, when you have capital flight, people selling shares, selling bonds, offloading investments, the net outflow of portfolio investment causes the currency to depreciate. Crucial point, often tested in exams, is interest rate differentials. So if a country has relatively high interest rates, that tends to attract hot money inflows into the banking systems. When interest rates go down, that causes an outflow. So hot money causes currencies to move. And this is something that's not really been tested in exams just yet, but just be aware of this. Let me explain it to you. Quantitative easing can affect the currency. So let's say, for example, the US government, the central bank, expands quantitative easing, creates billions of extra dollars on the balance sheet of the central bank. Some of those dollars will stay in the USA, but many of those dollars will leave in search of higher returns, land purchases in Brazil, whatever it is. Okay, typically countries with quantitative easing, that tends to bring down the yield on debt, increase the money supply. There's a net outflow of money from the economy, causing currency depreciation. So what I would suggest, if you take a screenshot maybe of this slide, just be aware of the key factors that cause a currency to move, and also be willing to use supply and demand analysis to analyze the cause of these currency changes. Let's move on to look at sterling against the dollar. This is a familiar chart. And again, the exams were set about a year ago. So if you get an exchange rate question or monetary union question, the data won't be bang up to date. This is up to yesterday, up to last night. And it shows sterling against the dollar. And critically, you can see on the chart that follow the blue line, particularly in 2022, the pound falling from about $1.30 into the autumn. And of course, we had the famous budget in September where the pound plummeted. It was getting close to parity, $1.05, I think, pretty much was the low point. Since then, the pound has recovered. But generally, sterling has depreciated against the dollar, certainly in the last year or so, and particularly since 2016. Now, over to you. Here's our chance for the Tutor 2 economics community to put in some amazing contributions. So here we go. I'll be watching the live chat carefully, and we'll put on the screen some great contributions. Can you give me, please, 3 reasons why the pound might depreciate against the US dollar? 30 seconds. Have a go. Some nice points coming through. Caitlin talks about economic uncertainty could cause maybe a loss of investor confidence. Charlie Nash talks about low demand for the pound. Joe talks about high inflation causing a deteriorates consumer confidence in the currency. Tom talks about falling demand for UK exports, possibly due to Brexit, but not necessarily. It could be due to world economic circumstances. Gabby has 3 points: interest rates, quantitative easing, and the dollar is used for trade. So there's obviously any supply or demand side factors. Bertie has a great point, Bertie Evans. The Bank of England perhaps may be coming to the end with interest rate rises, the end of the monetary tightening phase, whilst the Federal Reserve, likely will continue, causing an outflow of that money. That is a terrific point, understanding the asymmetry and timing between interest rate changes in the United States and in the UK. Some tremendous points there. A point about speculation among US investors about the running of the economy. Frank talks about possible trade wars. Nicole talks about lower interest rates. Some really, really good points. Let me give you 3 of my contributions. They're not necessarily better than yours, but I just want to focus on a couple of key things. One is the impact of the cycle on exchange rates. So, for example, a recession in the USA could lead to a decline in the value of the things that we export to the USA. The USA is our biggest single trade partner. 15% of trade goes with the United States. So if the United States has a recession, it'll be harder for UK exporters to export, and that could cause a fall in demand for pounds. Number 2, I think, is a really key point worth emphasising in your revision notes. Most of the commodities the UK buys are in dollars, and they have a low price elasticity of demand. So if the global price of those commodities, from copper to lithium to whatever wheat, goes up, that means we spend more on imports supply of pounds goes up, drives the pound down, because in particular, we have a low price elasticity of demand for those products. And point three, as a point I think a couple of people mentioned, Bertie Evans had a fantastic point about the Bank of England raising interest rates a little less quickly than the Fed. So if US interest rates rise faster than rates in the UK, that causes a net outflow of hot money. Crucial point here, use economic concepts, recession, global price of commodities, interest rates, hot money. These are the terms that make such a difference in an explanation or an examination question. Superb. Right, let's move on. Let's spend a few minutes thinking about another country. Again, the context here, you'll be given some context. You may not be familiar with the country necessarily. Let's look at Turkey. Here's a chart showing the Turkish lira to a dollar. So $1 back in 2012 would have bought you 2 Turkish lira. It now buys you close on 20. And in particular, what was happening in 2021, don't forget the exams were set in 2021, 22. The Turkish lira went into free fall. It lost 40% of its value against the US dollar from that kind of late summer 2021. Can you see that blue line going right the way up? And it's continued to climb into 2022. So we're now nearly at 20 lira to the dollar. Turkish economy growing strongly, 9% in 2021, yet analysts say this fast-paced expansion is unlikely to last because of the severity of the currency depreciation. So there's a bit of context on Turkey. Here's my question for you. Again, looking for some great contributions. Oh, before we do that, by the way, a bit of context. Turkish exports. This is from the OEC.world. Turkey exports significant amounts of cars and tractors. They have a significant textile sector, iron and steel. They obviously export food and drink. That's their export pattern. Their imports, well, they import machinery as well, precious stones, iron and steel. They import minerals, they import chemicals, they import plastics and things. So Turkey has a fairly complex export-import structure, but that might be useful in the question which is about to appear. Source there was OEC.world. Over to you on this one. Can you jot down for me, if you have time in 30 seconds, for 3 points, but if not, just go for 1 or 2. 3 benefits for the Turkish economy of a large 40% depreciation of their currency. 30 seconds. Let's see what you can come up with. So JB is saying that it's going to make Turkey more competitive. Yeah, actually, we're doing competitiveness in the next session. So it would make Turkish unit labor costs appear cheaper compared with, for example, Germany or Poland. Quite a few of you saying an increase in exports. Gerald's saying a better balance of payments. It's slightly cautious on the balance of payments. The balance of payments is always 0. So it's far better to say perhaps an improved trade balance or an improved current account. Paddy's great point is on the screen there. Turkish domestic producers would benefit from imports becoming more expensive, as consumers would purchase more domestically produced goods due to a substitution effect, a relative price effect. What I love about that answer is that it has a chain of reasoning and it brings in economic concepts, substitution effect, relative prices and things. Okay, so some great points there. Let's have a look at my suggestions. And I want to hint at 1 or 2 exam technique points. Here are 3 benefits. A lot of you said a boost to tourism, a boost to exports. For sure, exports go up. Make it more specific to Turkey. So I always try and put some application in. Turkey, we know, has a big tourism sector. So presumably a fall in the lira would be a substantial boost to their tourism sector. Not just to tourism, but travel and all the related industries. We know that textiles are 10% of their goods exports, typically price sensitive textiles. So that would make Turkey more competitive, perhaps when it's trying to export to the EU. I'll come on to the martial law condition in a second, Nicole. I'll mention that. By the way, crucially, Turkey, of course, is inside the European Union customs union. It's outside the EU, but it's negotiated participation in the customs union. A rise in exports could cause a positive accelerator effect on investment. So the Turkish tourism sector might invest more in new hotels and new facilities. Textile manufacturers might retool their factories and things. So you talk about an accelerator effect. And also generally the macro effects in terms of creating jobs, maybe higher real wages for people working in exporting, which in theory should contribute to faster growth for Turkey. Marshall learning condition, Nicole asked a question, can somebody explain it? It's basically the condition by which a fall in the exchange rate improves the trade balance. And the condition is that the sum of the elasticities of demand for imports and exports need to be bigger than 1. So that falling currency overall improves the net trade balance. Have a go at some evaluation now, 30 seconds. Can you please give me 3 risks or downsides for Turkey of a big depreciation? Have a go, please. Okay, we'll go through some answers in a second. Many of you talking about the risk of cost push inflation. Big thank, by the way, shout out to Frank and to Abbas for helping answer some of the questions that are coming up in chat, which is great. Here's a point: imports become more expensive, leading to an increase in cost for firms, so leading to cost push inflation. That's a really great point. How I would improve that, when I would give some application, say about firms such as Turkish textile firms, because Turkey probably imports cotton or yarn, and therefore an increase in variable costs would lead to cost push inflation. Here's a point from Robin I, which is a really nice point, which we'll put up on the screen, hopefully, coming up. Robin says local firms that import goods have higher variable costs. Love that. Instead of just saying higher costs, higher variable costs. Tremendous. That leads to lower profits. To counter, they may raise prices, which decreases social welfare. Superb point. Of course, the extent to which Turkish firms can raise price depends on price elasticity of demand and the stage of the economic cycle. And Mungo emphasizes that point. It depends on the price elasticity of demand for imports. Mungo Makosh Jr., Mungo Makosh Sr. would be extremely proud of that kind of point. Here's my 3 points. Again, for those of you adding to your revision notes, this could be applied to any country. Our case study is Turkey. You don't need to know anything about Turkey, but just try and apply it where you can. Yes, a 40% depreciation of the currency is going to cause increased cost push inflation. It might also cause demand pull inflation, particularly if the economy is close to a positive output gap, which then risks the loss of competitiveness. Crucially, I'm going to talk about this in a second, where we just walk through an analysis diagram together. A weaker currency makes the technology that the country imports more expensive. So Turkey might be importing computer hardware or software or construction materials, for example. Those costs, those prices would go up as well, which could cause Turkish firms to scale back their investment. And a really important point, which so few students mention, but I want to emphasize it to you today. A benefit of coming and joining in on the session. If the Turkish lira falls, the real value of Turkish debt, external debt, goes up, particularly if they have debt in dollars and euros. Many African countries, for example, have gone to the euro bond market to raise debt to fund government spending. And when their currencies go down against the euro, the real value of that debt goes up, and it makes it much harder to repay the debt. The risk of debt default increases. And when the Turkish government goes to the capital markets to raise more money in the future, a weak currency, volatile currency, implies the interest rate on that debt may go up. Okay, so we're going to talk, by the way, about competitiveness and supply side policies for those of you joining tomorrow. So there we go. I just want to take you through some analysis here. Just if you bear with me for 3 or 4 minutes. You'll often, if you get a question on exchange rates, you will be using aggregate demand and supply analysis to get the marks. Okay, the strongest answers in the summer this year understand that a currency movement, a depreciation, for example, can have short-term effects both on AD and aggregate supply. And also depends on where you are in the economic cycle. So let me just walk you through a set of diagrams just to show you how you can build stronger analysis. So here's a diagram showing what I think most students would draw. So a question on currency depreciation, most students would show an outward shift of aggregate demand and an expansion along the aggregate supply curve, causing higher GDP and a rise in the general price level. There's nothing wrong with that. That is a perfectly decent answer. What examiners are looking for this year, 2023, especially with grades being harder to get this year, they're looking for developed diagrams. So the next slide shows how you can shift the next slide shows GDP relative to potential. So a rise in exports helps to close a negative output gap. The next slide develops the diagram and says, well, there could be an export multiplier effect. So all those industries that service exports, trade finance, logistics, ports and things, they might invest more, leading to a further rise in AD to AD3. So what you've shown there is initial rise in exports, leading to an export multiplier effect. That just develops the analysis a little bit. And then to go to the next stage, and many of you have said this in your contributions to chat, higher import prices increase variable costs, the fertilizer costs more, the cotton costs more, causes an inward shift of short-run aggregate supply, which dampens the growth effect of a fall in the currency, but amplifies the inflation effect. I'll just take a moment here just to look at that diagram. That would be a level 4 analysis diagram, because you've developed it to show how a currency depreciation could affect both demand and supply in the sort of medium term. You could go further by showing a shift in aggregate supply in the long run, but this is the kind of diagram I would expect my students to be using to get the top marks for analysis. And once you've done that, by the way, the evaluation just becomes so much easier. Hopefully that was useful. We've got one more question to look at. Thanks for joining in today. Let's look at one more issue. And that is, before we do that, high-level analysis, we'll look at the context of a country. I'm getting ahead of myself here. So, for example, let's think about currency depreciation. Is a country a net importer or exporter of food and energy? That matters. Is it a net importer or exporter of technology? That matters, as we've just discussed. Significant point 3, how significant is their trade as a share of GDP? So UK trade is about 67% of GDP. For Malaysia, it's 140% of GDP. So currency movements for the Malaysian ringgit have a bigger effect than for the UK. For China, trade is only really 40% of their GDP. So the value of the Chinese currency is less important. Point 4, does a country have high external debt? We've mentioned that, haven't we? The consequences of a depreciation. And critically, this is a kind of evaluation point. We've talked about changes in the level of the exchange rate up or down. But actually, for many investors, it's not the level or the direction of change which matters. It's the variance. It's the standard deviation. It's the volatility that really matters. You might want to use that, for example, as part of your final reasoned judgment. Okay, I thought I'd leave time in this live session just to look at one more quick example, and I'm super excited to see what you can come up with this morning. That is the news about Croatia, a country who punches above their weight in football. They joined the European Union in 2013, and 10 years on, just a few weeks ago, they became the 20th nation to join the single European currency. If you get a question on monetary union, it is likely they may well choose Croatia. Really fascinating country to study. Here we go. The Croatian currency, the kuna, was fixed, operated in a fixed system. Had to be fixed, pretty much fixed against the euro for at least 2 or 3 years before you join the single currency. So it was about 7.5 Croatian kuna to the euro before they eventually shifted and switched on the 1st of January to the euro. And here's my question. As a group, what can we come up with? Can you please give me 3 advantages for a country such as Croatia from joining the euro? Over to you. Excellent as always. It's super hard, by the way, to write answers in 30 seconds, but it's a nice little exercise, isn't it? So people are saying stable currency, easier trade within the Eurozone, easier for Croatia to trade with other countries, with the Euro, 19 other countries. Romanza talks about stability. Jamie Westgate talks about greater certainty for exporters. And Gabby says they wouldn't need to exchange currency when importing. That's a really nice point. That's a micro effect. Oh, by the way, you can turn this question into a synoptic question. So assess the micro and macroeconomic consequences of joining the euro, or assess the micro and macro advantages of joining the euro, or disadvantages. Tom makes a great point here. Stable currency, improved investor confidence, transactions cost minimized. In your revision, by the way, it's super useful to keep trying these exercises. Give me 3 examples of this. Give me 3 points on that. Because if you can come across, you only need 2 points really normally to write a good answer. If you can give me 3, you're in great shape. And Druvit says, better integrated markets making trade more efficient and cheaper. Ishrat says, do you think this topic may come up this year, Jeff? Well, I think the answer is yeah. I think it could come up. I don't know, but there hasn't been a question on the single currency for some time. Here are my points. First of all, tourism. Of course, you probably know this, that Croatia is heavily dependent on tourism, Game of Thrones, all that kind of stuff. And I think this is a good example of an industry, a micro industry, which would certainly stand to gain from having a single currency. Reduces the conversion costs, of course, when you travel across countries. Every time you cross a border, you have to pay a conversion cost. So that should certainly stimulate the tourism sector and related industries, travel and tourism, leisure and so forth. Crucially, the second point is quite important. Let me just go through that with you. Croatia is hoping that joining the euro will give it a more stable currency. It's obviously a bigger currency, the euro. Now, if you have a more stable currency, that brings down, reduces the investor risk of buying Croatian government debt, for example, because the euro is relatively stable. And therefore, the yield on Croatian government debt would come down, which would make it less expensive for the Croatian government to borrow to fund education or healthcare or housing or infrastructure. So that's really quite an important point. The other thing, if you're aware that Croatia and lots of other countries, including the Baltic states, they have been suffering depopulation. Poland, likewise, but Poland's chosen to stay outside the single currency. And Croatia plans to join the Schengen border-free travel zone. So therefore, having a single currency and joining the Schengen zone means it's more likely, perhaps, to attract younger people to live and work in Croatia, or people relocating. So that should, in theory, help to reverse depopulation and the brain drain, which a couple of people have mentioned in the chat window. Rob says, I thought Croatia was in Africa. Well, Rob, I hope you're not taking A-level geography. The Croatians would be particularly annoyed if you thought that was the case, but maybe you might head to Croatia as part of your African gap year experiences. Now, what about some disadvantages? Here's our last opportunity for you to throw in some amazing comments. We'll try and give a shout out to those people. What about 3 drawbacks, risks, downsides for a country such as Croatia joining the euro? What can you come up with? Some great points coming through, and Ishrat has a lovely point here. If we go back to Ishrat's point about all EU countries have different economic cycles, that's true. Although before you join a single currency, you have to have some degree of convergence. But a common interest rate set for all members might cause a depreciation in living standards if in a recession. That's the idea of one size is very hard to fit all countries. A couple of people talking about the trilemma that you can't have control over your currency and interest rates and so on. Lots of really good points coming up. Druvit says loss of independent monetary policy, which in turn could be beneficial for some countries but may not apply to Croatia. Come back to that point in a second. Gabby talks about losing control over monetary policy. Hannah makes a lovely point. The single monetary policy of the euro may not work best for Croatia's conditions. Very great point, Han, because Croatia has, I think, about something like 0.5% of Eurozone GDP. It's tiny, absolutely tiny. So their economy has no bearing at all on interest rate decisions set by the ECB. Well, my 3 points were as follows, overlapping a little bit with your excellent contributions. Joining the euro means that Croatia gives up the option of running an independent monetary policy, so they can no longer set their own interest rates, although they really couldn't before they joined because they had a fixed currency against the euro anyway. But anyway, secondly, crucial point, Croatia gives up the option of a managed depreciation of the currency. So the kuna, maybe the Croatian Central Bank could have intervened to manage the currency. They no longer can do that. And joining the euro, oftentimes businesses use that as an opportunity to raise prices, maybe turn over consumers, make higher profits. And it often leads to a surge in inward investment, which causes house prices to go up, rents to go up, which makes wealth inequality rise and makes it much harder to afford property. But some great points, staggeringly good points from the Tutor2 community this morning. So just to round off, just in terms of context, every European Union state, if you join the European Union, you must introduce the euro once you fulfill the convergence criteria. But you don't have to join. You can choose the timing. So the countries at the moment that are inside the EU but don't have the single currency are Bulgaria, has the lev, Czech Republic, Denmark, krona has a fixed rate against the euro, Hungary, Poland, the zloty, Romania, and Sweden. So those countries are technically supposed to join the euro, although Sweden and Denmark have voted not to join in a referendum. So keep in mind, they could ask you a question about any country. Doesn't matter what it is. Quick reminder, as we draw this session to a close, that we are heading across the UK in the weeks to come. We're at Bristol, Birmingham, Leeds, London, Manchester, Portsmouth. I think there's some great sessions coming up. We are super excited to be running our live revision workshops. Thousands of students coming. It'd be great to meet you if you can make it. If you sign up for one, you get not just the day itself and the booklet, but you also get access to this fantastic Grade Booster online course, which is just stunning as a revision support. So please, if you are keen to come along, join us on one of those dates. Super excited to meet you and have an intensive day of revision. But for now, thank you for joining in this session. It's been absolutely fantastic. I'm doing a session tomorrow, same time, same place, on competitiveness and supply side policies. I think that will link in quite nicely with the stuff we've done today on exchange rates. If you found the session useful, then it's super important to us, and we're very grateful if you press like and maybe subscribe to the channel so that the YouTube algorithm allows other people to find what we've just done. All of the live streams we've had over the last 2 or 3 years are recorded. They're in our live stream archive. You just go to tutor2.net and search economics, live streams. You can go through all of the previous sessions. Lots more live streams to come in the weeks ahead as we gear up for exams. Thank you very much for joining in today. Take care, stay safe, stay happy, stay healthy, and see you soon.